If you have more than 2 credit cards in your wallet, you're probably overcomplicating things. Today, I'm walking you through the 2-card rule, exactly which cards to get, why you need them from different banks, and how to stop falling for the credit card industry's complexity trap. Plus, I'll show you why bank account closures are way more common than you think and how to protect yourself. Welcome to Simple Finance Bites. I'm Ernest, and this is where we cut through financial industry nonsense and give you strategies that actually work. Quick bit of housekeeping here. If these episodes are helping you, the best way to support the show is subscribing wherever you're listening and sharing with someone who needs to hear this stuff. It really does make a difference. Also, if you want more detailed guides and templates that go deeper than what we can cover in these episodes, make sure you're signed up for our free newsletter at simplefinancebites.com. I share additional insights there that don't make it into the podcast, including step-by-step implementation guides. Today, we're talking credit cards, and I'm going to give you a framework that goes against most of the advice you'll hear online. Instead of juggling multiple cards trying to optimize every purchase, we're going with 2 cards. That's it. But before we get into which cards, let me tell you why most credit card advice is designed to make your life harder, not easier. The credit card companies have spent decades and billions of dollars convincing everyone that you need a different card for every spending category. Gas card, grocery card, Amazon card, travel card. And don't forget those rotating quarterly categories you need to activate every 3 months. What's in your wallet? This is not an accident. They want you overwhelmed because overwhelmed people make mistakes, and mistakes are incredibly profitable to the banks. The credit card industry has spent billions figuring out exactly how to hack your brain. They know that when you're standing in Target trying to remember if this is the quarter when your Chase Freedom gives 5% on Target, your brain is going to short circuit. You'll use the wrong card, forget to activate your bonuses, miss payments because you can't track 5 different due dates, or just give up and use whatever card is easiest to reach. I know years ago when I first started using credit cards, I got caught up in this mentality too and was trying to optimize everything. Until I sat down one day and thought about it and realized it is not worth the time nor the mental energy. Let me give you some real numbers here. The average American has 3.84 credit cards, so let's just say 4 credit cards. But studies show that people with more than 2 active cards make significantly more mistakes. Wrong card usage, missed optimizations, late payments. The complexity cost outweighs the rewards benefit. Think about it from a psychology perspective. Your brain has limited decision-making capacity every day. Every time you have to think about which card to use, you're using up some of that mental energy. By the end of the day, when you're tired and your decision-making is depleted, you're going to mess up. The credit card companies know this. They design their systems to be just complex enough that you'll make profitable mistakes, but not so complex that you give up entirely. It's a carefully calculated balance designed to extract the maximum profit from you and your mental fatigue. The math might look good on paper when you're sitting at your computer with a spreadsheet, but psychology beats math every time. You're leaving money on the table because the system is too complicated for your brain to handle consistently in real-world situations. And here's the thing that really bothers me. Most financial advice completely ignores this human element. They'll tell you to get 7 different cards and optimize every purchase like you're some kind of robot that never gets tired, never gets distracted, never makes mistakes. That's not how humans work. People have a life. People are busy. People are parents, people have careers, people have many other things going on in their life that don't need to sacrifice mental energy for credit cards. If this is hitting home and you're realizing your current credit card setup is costing you money, make sure you're getting all our latest guidance. Head over to simplefinancebites.com and sign up for our free monthly newsletter. I share detailed strategies for optimizing your entire expense picture, plus step-by-step guides for building wealth through simple finance principles. No fluff, just actionable advice to help you stop losing money to the credit card industry's complexity trap. Here's what works better: the 2-card rule. 2 cards, different banks, clear purposes. That's the entire system. Let me repeat that. 2 cards, 2 different banks, clear purposes. This is a psychology-first approach. Your brain can easily handle 2 simple rules. Your brain cannot handle 7 different bonus categories that change every quarter, plus activation requirements, plus spending minimums, plus all the other complexity the credit card companies throw at you. Again, they do it on purpose. They know that you are overloaded mentally right now, especially in today's day and age with the economy the way it is and everything going on in the world. We are all mentally exhausted at this point, and they are taking advantage of that. So, the 2-card framework. Here we go. Card 1 is your foundation, a 2% flat rate card you use for everything. Now, I say 2%, 1.5% is fine, 2.5% is even better, but 2% is kind of that median. I call it the table stakes or the floor. That's where you want to be at. There are no categories here, no rotations, no caps, no thinking required, no activation. Every purchase gets you 2% back, period. Think of it as you're just getting a 2% discount on everything you buy. That's the way you want to mentally picture this. That's card 1. It's your foundation card. Card 2 is your optimization card. Either higher rewards in your biggest spending categories or a travel card if you want that flexibility. For example, in my case, we travel a lot as a family, so I really do value travel cards, but we also spend a lot on food. So I'll talk about that a little bit later. But here's the part that most financial advice completely ignores, and it's the most important part. Those 2 cards need to be from 2 different issuers, 2 different financial institutions, whether it's banks or credit unions, doesn't matter. Not different card products from the same bank, okay? So not 2 Chase cards or 2 American Express cards or 2 cards from your credit union. 2 cards, 1 from each a separate institution, different banks entirely. Why? Because banks close credit card accounts and checking accounts randomly, and it happens way more often than people realize. Especially today, banks are using AI to try to look for fraud and other random things, and AI is not perfect. It makes mistakes. Let me tell you what's happening on Reddit right now. There are entire threads of people with perfect payment histories, 800 plus credit scores, getting their accounts shut down for routine portfolio review or business model changes or other vague corporate speak. These aren't people who are abusing the system or missing payments. These are model customers getting dropped without warning. A lot of times it's a result of AI flagging their account for something, and then they just close the account. Just last month, I saw posts from people who had their Chase accounts closed after years of perfect payments. American Express has been doing financial reviews and closing accounts. Even smaller banks and credit unions sometimes make business decisions that affect their credit card programs. Many years ago, I used to have a United credit card from Chase because I was using United Airlines to fly for business many times a year. The route that I was taking on United got taken away by United, the direct route, and therefore I had to do a transfer. And so I stopped taking United and started taking a different airline that had a direct route. Because I didn't use that credit card as much as I had before, Chase eventually closed the account. And I lost the available credit on that as a result of that closure, which, in the grand scheme of things, wasn't a massive hit to my credit score or anything like that. But it still showed me that banks have zero appreciation for you as a customer. They don't care. They will just shut it down for whatever reason. And in their case, the reason was because they weren't profiting off of me as a customer on that card. Banks are not your friends. They will drop you the moment you're not profitable enough or their business model changes. And they don't give you advanced warning. You'll wake up one day to an email saying that your account is closed effective immediately. As a matter of fact, banks don't even need to explain why they closed your account. So many people on Reddit say that they got their accounts closed, they called up the big bank's customer service to ask why, and they were just told that they could not tell them why. but that they would receive a letter in the mail. And then if there was any money left in, for example, a checking account, a check would be issued to the address on file. No explanation as to why it happened. And they don't have to by law. That's insane. So if all your cards are with one bank and they decide you're not worth keeping, you're suddenly stuck with no available credit, no backup plan. And because you take a hit to your credit when that happens, it could take weeks or months to get approved for new cards elsewhere. That's the bigger issue if you don't have the backup plan. So when I say different issuers, what I mean there is if Chase closes your account, you still have your American Express. Two completely different banks, two different issuers. If your credit union has issues, you still have your Capital One card. If American Express decides to review your account and you're not profitable and they shut you down, you still have your credit union card. This isn't just theoretical risk management. This is real protection against something that happens to thousands of people every month. The personal finance subreddit is full of these stories, and most of these people had no backup plan. It's basic risk management that no one talks about because the credit card companies obviously don't want you thinking about this stuff. Now, let's get specific because I know you want to know which cards to apply for. For your flat rate card, find a local credit union if you don't have one. And if you do, go look at their offerings. Most credit unions offer 1.5 to 2% cash back with no annual fees and way better customer service than the big banks. Credit unions are member owned, which means they're not trying to squeeze every penny out of you like Bank of America or Wells Fargo. I was so fortunate that I became a member of a credit union when I was around 12 years old, back home in Texas, and I'm still a member of that credit union to this day. When I turned 18, I got my first credit card from them, and it turns out it was actually a great credit card. It's a flat 2% cashback Mastercard. No fluff, no games, no categories, none of that, just 2% back on everything. And that was my first card, and I still have that card to this day. I also opened an account with a local credit union when I moved to California. They have a 1.5% cashback card. Same thing, no fluff, no categories, no crazy stuff, just a straight 1.5% cashback card. But here's the thing that's great about those two cards. They have a ton of insurances and protections on them. When you get credit cards from banks, a lot of times when you get the lower tier card, the no annual fee cards, things like that, they strip away some of the protections like purchase protections or travel protections, travel insurances, rental car insurances. They strip that away because they're not making money off of you on an annual fee. The great thing about these two credit union cards I have is that not only are they flat 2% and 1.5% cash back, they have a ton of travel and purchase protections on them. They are great credit cards. So look at your local credit union first. The difference in customer service is night and day. When you call a credit union, you're talking to someone who works for an organization you actually own a piece of. You're a member of that credit union. When you call Chase or Bank of America, you're talking to someone whose job is to extract maximum profit from you while giving you the minimum service required to prevent you from leaving. That's right. That agent is trained to make money off of you, not to help you. The helping you part is just there to keep you as a customer. They're really there as salespeople. If you're not eligible for a credit union or they don't have a good 1.5% or 2% option, here are some solid alternatives. The Fidelity Rewards Visa. I personally have this card and I love it. The Wells Fargo Active Cash or the Citi Double Cash. These are all legitimate 2% cards with no annual fees. The Fidelity card is particularly good if you have or want to open a Fidelity investment account because the integration makes everything seamless. So in my case, the Fidelity Visa is my flat 2% card. And the main reason is because I take all of my cash back and I reinvest it into broad index funds. And I also use my Fidelity CMA, my cash management account, as kind of my central hub for finances. So it all works together as one system. And that's why that card is amazing. So if you are already a customer of Fidelity, say your workplace 401k or your Roth IRA is there, look into the Fidelity cash management account as well as the Fidelity Rewards Visa. It's an excellent card. The Wells Fargo Active Cash is straightforward, 2% on everything, no complexity. The thing to be careful with on the Wells Fargo card is if you are an international traveler, it does have a foreign transaction fee. The Fidelity card does not. As a matter of fact, the Citi Double Cash card, which we're also going to talk about here, also has a foreign transaction fee. So be very careful with those two and using them outside of the country or purchasing things online from outside of the country. The Fidelity card is much better in that route. Now, the Citi Double Cash technically gives you 1% when you spend and 1% when you pay it. But since you're listening to Simple Finance Bites, you know that that works out to 2% total if you pay your statement balance in full every month, which is our mantra on this show. You always pay your credit card in full every single month. Never carry a balance, never pay 1 penny of interest to a bank. For your second card, this depends on your actual spending patterns, not what you think your spending patterns are or what you wish they were. So what you want to do is at the end of the month, sit down and look through your credit card statements and or bank account and figure out where are you spending your money. For most Americans, our highest expense is our home, whether it's rent, a mortgage, whatever the case is, that's number one. Number two is usually food or cars, depending on your situation and where you live. But for most people, food is a very high expenditure, and that's both groceries and dining out. So figure out where your spending patterns are, and then figure out what your second card should be to align with that. So for example, if food is your biggest category after housing, and again, for most people it is, in our family it definitely is, got to feed a family of 4, we eat a lot of food. Something like the Capital One Savor makes sense. It gives you higher rewards on dining and groceries, which probably covers a significant chunk of your monthly spending. Let's do some quick math here. If you spend $1,000 a month on food between groceries and restaurants, and the Capital One Savor gives you 3% on dining and on groceries, while your flat rate card gives you 2%, you're looking at an extra $10 per month just from using the right card for food. That's $120 per year for literally zero extra effort, right? And then you have to ask yourself, is it worth it? Well, in this case, you need a second card for risk management. So if you're going to have a second card, I think this is worth it. It's not a tremendous amount of money. It's $120. It's $10 a month. But if you're investing that like I am, that is compounding and growing every single year that goes by. So in my opinion, it is worth it. Now, if you want travel flexibility or your spending is pretty evenly distributed across categories, the Wells Fargo Autograph or the BILT Mastercard work well. The Wells Fargo Autograph gives you 3x points on travel, dining, and some other categories, plus it has cell phone protection and other travel benefits. The BILT card is really interesting because you can earn points on rent, and most other cards charge fees for rent payments or don't allow them at all. Since rent is probably your biggest monthly expense, that can add up fast. If you're paying, say, $2,000 a month in rent, that's 2,000 points per month just for paying your rent with this card instead of a check or a bank transfer. And again, there are no additional fees for this. So my personal setup is a BILT Mastercard and a Fidelity Visa. I use the BILT Mastercard for rent, dining, and travel, and everything else that doesn't require a Visa. My Fidelity Visa is primarily used at Costco because Costco only allows Visa. And if you're feeding a family of 4 and you're not buying at Costco, you're doing it wrong. Now, notice what I'm not recommending here, and this is important. Cards with annual fees. The credit card companies have spent millions convincing people that you need to pay annual fees to get good rewards. That's complete nonsense and designed to separate you from your money. Now, I'm not saying that you should never have a card with an annual fee or that all cards with annual fees are bad. There are actually some very solid travel cards in the, say, sub $100 annual fee to maybe $150. But anything above that, you're wasting your money unless you travel a lot. And 99% of people don't travel that much. Ready to optimize your credit card strategy but want personalized guidance? I help people set up their complete expense optimization system, from choosing the right credit cards to optimizing bank accounts, phone plans, and subscriptions. Visit simplefinancebites.com to learn about our one-on-one expense optimization educational coaching, and don't forget to sign up for that free newsletter while you're there. Unless you're really deep into travel rewards and you know exactly what you're doing, which is way beyond what we're covering today, you don't need to pay annual fees. There are excellent no-fee options that will serve you well. The annual fee cards are designed for people who either travel constantly for business or who treat credit card optimization like a part-time job. That's not our audience, and it's probably not you. So how do you use this system? Implementation is simple because simple systems actually work, and complex systems fail in real-world conditions. Here are your 2 rules. Use your category card for its bonus category only. Use your flat rate card for everything else. That's it. Super simple. So if you have the Capital One Savor for dining and groceries, use that card at restaurants in the grocery store. Everything else, gas, utilities, online shopping, random Amazon purchases, subscription services, all of that goes on your 2% card. In my case, the way I do it is everything goes on my BILT card that can go on it, and then the Fidelity Visa is everything else. So primarily Costco. Very, very simple system. This is psychology first personal finance. 2 simple rules your brain can remember without thinking. No decision fatigue. No standing in checkout lines trying to calculate which card gives you the best return on this specific purchase. Again, decision fatigue is something that I wish more people would look into. A lot of people don't realize that it is affecting them. In my opinion, it's affecting everybody. I remember probably 10 years ago, I had become so affected by it that I decided that I was going to wear the exact same thing every single day. So I went out and bought 10 of the exact same gray t-shirt, multiple pair of the exact same set of jeans, shorts, etc. And I literally wear the same thing every day. That reduces the decision fatigue. And let me tell you why this works so much better than complex optimization strategies. Your brain operates on this decision fatigue. Every decision you make during the day uses up a little bit of your mental energy. By the end of the day, your decision making gets worse and worse. And I think all of us can attest to that. As we get towards the end of the day and we are tired, we start making mistakes. We might get angry faster or upset faster, or we're in that zone where we're just done with people. That is a result of decisions and other things sapping your energy throughout the day, not to mention physical energy, because most of us have to work and do all these other things. So anything you can do to preserve your mental energy matters here. And decision fatigue is something that's sapping that like a little vampire. So the system we're setting up here, the 2-card system, helps preserve your mental energy and your mental peace. If you have to think about which card to use for every purchase, you're burning through that mental energy on something that doesn't really matter that much. You'll end up making worse decisions about things that do matter, like whether to buy something in the first place or whether you're staying within your budget. Simple rules become automatic. You don't have to think about them. You just do them. And automatic behaviors are incredibly powerful because they don't require willpower or mental energy. You're not leaving significant money on the table with this approach, but you're also not creating a system so complex that you can't use it properly. And here's the key insight that most financial advice misses. Simple beats optimal every time, because simple systems get used consistently and optimal systems get abandoned when life gets in the way. Let me give you a real example. Let's say you could theoretically get an extra $120 per year by having 4 different cards and optimizing every purchase. Now, earlier I gave you an example where you got $120 a year just by using 2 cards. But let's say with 4 cards, you add more onto that. But if the complexity causes you to miss one payment and get hit with a $35 late fee, plus potential interest charges, you've wiped out a significant portion of that optimization. And if it causes you to avoid thinking about your finances altogether, the opportunity cost here is massive. That's not good. Set up autopay on both cards, but still review your statements monthly. Autopay prevents late fees and missed payments, but you need to stay aware of your spending patterns and make sure there are no fraudulent charges. So here's a pro tip on how to do that. Set your autopay for the minimum payment on each card. I know, here on Simple Finance Bites, we say you always pay your card in full every single month, but here's the thing. When you set up the autopay for the minimum payment, You're just doing that so that if for some reason you forget to make the payment or something else happens, let's say there's an emergency and you end up in the hospital and you're unconscious, right? You don't want that to happen while you're down. So doing it this way ensures you never miss a payment, but you still have to log in and review and pay your statement balance in full every month. This keeps you engaged with your finances without creating the risk of late fees. That's why you do it this way. If you're listening to this and you currently have more than 2 cards, don't panic and don't close anything immediately. Closing credit cards can hurt your credit score, especially if you close older cards or cards that make up a significant portion of your available credit. This is kind of what happened to me with that Chase United card. It's not a huge impact, but it is a negative impact. Generally speaking, you shouldn't rush and panic with any financial decision. But if you're listening to this podcast and you're thinking, you know what, this makes sense. I should only have 2 cards, but I have 4. You don't need to close the other 2, especially if they have no annual fee. There are things you can do to keep those credit cards alive, keep your total available credit higher, and still make sure that you don't miss payments and all that kind of stuff. We can talk about that later. It's a little bit more of an advanced strategy, but it is possible to do that. The point is, don't panic and go closing cards after listening to this podcast. Take your time, think through it. Here's how to transition to the 2-card system. First, you choose your 2 primary cards based on the framework we just covered. Put the other cards in a drawer and stop using them. Keep them open, but inactive. After a year of not using those extra cards, you can consider closing cards that have annual fees. But keep older cards open if they don't have annual fees, because the age of your credit accounts is a factor in your credit score. The reason I emphasize consider there is I'm of the mind that if you have a card with an annual fee and you're not using it, you should absolutely close it. However, you want to make sure that you don't need that card anymore before you close it. With no annual fee cards, I generally say just keep them open, keep them alive with a little tiny recurring charge or something like that, but you don't need to close them because there's no annual fee. Obviously, if you're overwhelmed and you feel like you need to close some cards, do it. Don't sacrifice your mental health for this, but at the same time, you don't have to rush to close things down. Take your time, think your way through it, make sure you're making the right choice. Now, if you don't currently have the right cards for this system, you can apply for new ones, but be strategic about it. Don't apply for multiple cards at once because that can hurt your credit score. Space out applications by at least a few months. I generally recommend that people space them out at least 6 months apart. That looks better to the banks. It doesn't make you look desperate like you're looking for credit. And it makes it to where if there's a better card that comes out that just suits your situation better, you have a lot of open space there where you can apply for it. And you're not in a position where you can't get it because you've opened too many cards or you have other things on your credit report. So remember, take your time with financial decisions. Another thing, remember different issuers. If you currently have 2 Chase cards, that's not diversification. You want something like a credit union card and a Capital One card, or a Chase card and a credit union card. The goal is to have backup credit available from a completely different banking institution so you're protected against the account closure risk we talked about earlier. All right, so that's the 2-card rule. Simple, effective, and designed to work with your brain instead of against it. If you found this helpful, please subscribe to the podcast on whatever platform you're using. YouTube, Spotify, Apple Podcasts. It really helps more people find these conversations. And if you're getting value from the show, sharing it with someone who could use some financial clarity makes a huge difference. If you want more content like this, including detailed guides and tips you can actually use, make sure you're signed up for our free newsletter at simplefinancebites.com. I share additional insights there that don't make it into the podcast, including step-by-step implementation guides for strategies like this one. If you're listening to this and realizing your current credit card setup needs work, or you want help optimizing your entire expense picture, not just credit cards, but bank accounts, subscriptions, phone plans, insurance, all of it, that's exactly what I help people with my expense optimization educational coaching. This isn't just about credit cards. It's about creating simple, sustainable systems for all of your expenses that actually work with how your brain functions. You can learn more at simplefinancebites.com. I only work with a limited number of people each month because I believe in giving everyone the attention and customization they deserve. Before you go, next week we're diving into subscription audits and finding the silent wealth killers hiding in your monthly expenses. If you think you know all your subscriptions, I guarantee you're going to be surprised. We'll cover how to find subscriptions you forgot about, the psychology of recurring payments, and how to make decisions about what to keep and what to cancel. Keep it simple, and I'll talk to you next week.